Welcome to the eBusiness Playbook podcast, proudly sponsored by Ocademy Global, where we help you go from theory to reality, empowering you to elevate your e-business. Join our open community at the eBusiness Playbook by Ocademy on Facebook and LinkedIn, and check out our training packages at ocademyglobal.com to find out more.
Welcome to the eBusiness Playbook. Hey there, future founders and entrepreneurial thinkers, ready to get into the real mechanics of launching your own venture. Today, we're taking a deep dive into something absolutely vital. It's about turning that brilliant business idea of yours into, well, a real breathing company. We're talking seed investment and seed funding. We've been digging through quite a bit of information about how startups get that crucial first financial boost, and our goal here is really to make it crystal clear for you. If you're dreaming of building your own e-business, understanding seed funding isn't just helpful, it's essential. So we're here to break it down and hopefully spark a few aha moments.
Absolutely. And that initial capital, it really is the catalyst. It transforms an early stage concept, maybe it's still just notes or sketches, into a tangible business venture, one with real potential. Yeah. It's the fuel you need for those critical first steps, developing a minimum viable product, something you can actually show customers, and really validating if there's genuine demand for what you're building. Plus, bringing together that initial core team, the talented, dedicated people who will help bring the vision to life. It's more than just having cash. It's about building the foundation for, well, everything that comes next.
Okay, so when we talk about this initial money coming in, it's not just one size fits all, is it? Our exploration pointed to several different paths a new entrepreneur might take. Let's kick off with something that's very much in the founder's control: bootstrapping.
Right, bootstrapping. As the name kind of suggests, it's about using your own resources, your own money. This could mean, dipping into personal savings, maybe reinvesting any early revenue the business scrapes together, or even just cutting back personally to free up cash for the startup. The big advantage, the really significant one, is you keep complete ownership and control. No external debt early on. But as the research shows, the pressure, it can be intense. Pressure to get revenue flowing, see a return on that personal investment fast, and that pressure might lead you to, well, maybe cut corners on long-term strategy or product refinement just to get quicker gains. Maybe not sustainable gains, though.
Yeah, you're basically betting the farm on yourself financially. Brave, definitely, but like you said, feels like walking a tightrope. Now, another avenue we hear a lot about, angel investors. What's the lowdown there?
Angel investors. These are typically high net worth individuals, people investing their personal funds in early stage companies. In return, they usually get equity, a piece of the company, or sometimes convertible debt. What's really interesting, though, is they often bring more than just the money, a lot more. Many have serious experience themselves, maybe as entrepreneurs or execs, so they offer invaluable mentorship, strategic advice, and access to their networks. That can be huge for a young company facing those first big hurdles. An angel with marketing savvy might guide your early customer acquisition, or one with industry ties could open doors to key partnerships, stuff you couldn't get otherwise.
That sounds like a powerful mix, the cash plus the wisdom. Okay, what about using the power of the online crowdfunding platforms?
It's crowdfunding. It's really opened doors for entrepreneurs who maybe don't have those traditional investor connections. These platforms let you pitch your idea to a big online audience, and people can chip in, often small amounts. Usually, they get early access to the product, discounts, maybe some other perks in return. A key advantage, as our sources highlighted, is raising capital potentially without giving away equity like you would with traditional investors. But it's not without its challenges. There's a real risk of putting your intellectual property out there publicly before it's fully protected. Plus, those platform fees can take a bite, typically, 5% to 12%? And it takes a really compelling story, a lot of marketing, community engagement just to stand out and hit your funding target.
Definitely pros and cons to weigh carefully there. Okay, what about closer to home? Tapping into your immediate circle, friends and family rounds.
Yes, and that's often a very natural first port of call for many founders. It can feel less formal, maybe less daunting than pitching strangers. There's usually that built-in trust, a willingness to support you personally. However, the resources we looked at really stress treating these investments professionally, utmost professionalism, because mixing personal relationships and money, even with the best intentions, well, it can lead to strain or conflict if the business doesn't go as planned. It is crucial to have clear written agreements. just like you would with any other investor.
Uh-huh.
Protects the business, protects the relationship.
Absolutely crucial. You definitely don't want awkward Thanksgiving dinners about ROI. Okay, moving towards more institutional players now.
Yeah.
Seed funds. How do they fit into this early stage? Seed funds, think of them like venture capital funds, but laser focused on these very early stage investments. Startups just getting started, they pool capital from institutional investors, pension funds, university endowments, wealthy families, things like that. Now, funding from them can come in different flavors. There's the unpriced round, where the company's valuation isn't set initially. It gets figured out later, often based on a bigger future funding round. Then you have SAFEs, simple agreements for future equity. These are meant to be straightforward ways for investors to get equity later, again, usually tied to a future funding event. And of course, they also do traditional equity investments, much like angels, but often with bigger checks. These funds typically offer larger amounts of capital than individual angels or crowdfunding. That lets startups really hit the gas on product development, market research, and building out that initial team.
So quite a spectrum of options then, each with its own flavor and things for a founder to think about. Now, once a startup actually gets some of this seed money, where does it typically go? What are those first crucial uses? Mostly, it fuels those foundational things we mentioned earlier. First and foremost, product development. Building out that functional version, often the minimum viable product, the MVP, to test with real users. Market validation is also absolutely critical. Using funds to figure out, okay, is there real demand? Who are our ideal customers? How do we reach them effectively? Then comes initial hiring, bringing on those key early team members with the right skills and, importantly, the passion. And finally, showing some proof of concept, some early traction, maybe initial user growth, positive feedback, something tangible that helps attract future investment. It's also worth noting, as our sources pointed out, many startups actually go through multiple seed rounds. It's not always a one-and-done deal as they hit milestones and need more capital to grow.
That makes sense. It's iterative. And interestingly, the AFA we looked at also mentioned some shifts in the seed funding world lately, especially after that big peak around 2021. What's the current climate like?
Yeah, that's fascinating. The data suggests a trend, a decline actually, in both the number of seed deals happening and the total money invested in the U.S. after that 2021 high point.
Yeah.
It suggests the environment's gotten more competitive. Investors might be a bit more cautious, more selective perhaps. For founders, well, it really underlines the need to be exceptionally well prepared. You need a truly compelling case to stand out and secure that crucial early money now.
That definitely raises the stakes for anyone listening who's trying to get their own startup going. So if that's you, what are the absolute must-dos? How do you get ready for this seed funding journey?
Preparation. It is absolutely key. And the heart of that prep is a comprehensive business plan. And this isn't just a quick document. It needs to clearly lay out your product or service, detail your financial projections, and crucially, outline your funding needs, how much you need, and exactly how you plan to use it. Alongside that plan, a compelling pitch deck. It's non-negotiable. Think of it as the visual story of your business potential. It needs to grab attention fast, clearly communicate your vision, your market understanding, and make a persuasive case for why investors should back you.
Right. The business plan is the detailed map, and the pitch deck is the engaging travel brochure that gets investors excited. Now, when investors are actually looking at these early companies, what are the key factors that really influence their decision? What makes them say yes?
Several things, and they're often linked. Market demand is huge, paramount. Investors are looking for solutions to real, significant problems or needs in a sizable market. You absolutely have to demonstrate the potential market size, pinpoint the customer pain points you're solving, and show the potential for significant growth. Backing this up with credible stats, market data, industry trends, that's essential. And it's not just the total market size. Investors often like to see you've identified your beachhead market, that smaller, focused segment where you can win early and build from there.
So it's not enough to have a cool idea. It needs to be a cool idea that a big group of people actually need and will pay for. What else is high on their list?
Financial traction, even at the seed stage, can be a big plus. Even early signs of success matter. Things like initial revenue growth or showing you understand key metrics like CAC, customer acquisition cost, how much it costs to get a customer, and LTV, customer lifetime value, the total revenue you expect from a customer over time. Showing you grasp these builds huge investor confidence. It shows you're not just burning cash, you're starting to build something potentially sustainable.
Right. Numbers talk, even early numbers. Okay. What about the people, the team behind the idea? How critical is that?
Oh, absolutely critical. Investors aren't just funding an idea. They are funding the people executing that idea. They want to see a well-rounded, capable team, people with relevant experience, the right skills, and importantly, shared passion and commitment to the mission. Highlighting each person's qualifications, their past wins, how their skills complement each other. That really reassures investors you've got the right crew to navigate the startup roller coaster.
It's like they're checking out the jockeys as much as the horse, right? And we mentioned the pitch deck, but how much does the overall polish, the preparation, the presentation itself matter?
It matters a lot. A meticulously prepared professional pitch deck that is clear, concise. It communicates your vision, your market insight, any early traction, and that detailed funding use breakdown we talked about. That can make all the difference. Investors see tons of pitches. The ones that are clear, compelling, well-structured, those are the ones that stick. They leave a positive, lasting impression.
And lastly, it's not just about having the perfect plan and team. Connecting with the right investors matters too, doesn't it?
Precisely. Using your network for introductions is valuable, definitely. But maybe even more important is doing your homework. Researching and identifying investors whose focus, whose investment thesis, aligns with your industry and your business model. A targeted strategic approach beats a scattergun approach every time. You want investors who don't just write checks, but who understand your market, who get what you're doing, and can potentially offer that valuable strategic guidance and connections down the line.
So finding strategic partners, not just ATMs. Okay, let's dive a bit deeper into the actual numbers. What metrics really catch an investor's eye at the site stage?
Well, we touched on a few, but let's elaborate. Revenue and growth rate are key. As the research suggested, typical benchmarks for seed stage might be MRR monthly recurring revenue, maybe $10K to $100K, or ARR annual recurring revenue, maybe $100K to $1 million. But remember, the absolute numbers are just part of it. The growth rate, how fast you're growing that revenue, is often seen as equally, if not more, important. It shows momentum, future potential.
Okay, so proving not just that you make money, but that you're making more money rapidly and consistently. What about the value derived from customers over time?
Right. Long-term customer value, LTCV, that's another critical one, even if it's more projected at this early stage. It's basically your best estimate of the total revenue you'll get from a single customer throughout their entire relationship with you. Now, investors don't expect pinpoint accuracy here, not at the seed stage. But a well-reasoned understanding of the concept and showing a positive trend is highly valued. It speaks to the long-term health and profitability of the business model.
Makes perfect sense. Show you're building lasting value, not just quick hits. And we talked market understanding. What specific parts of that analysis do investors focus on?
They really want to see you've done the work, that you grasp the opportunity realistically. They're often looking for big addressable markets, potential in the hundreds of millions, ideally over $1 billion for the larger funds. But it's not just about the total size. It's understanding the segments within that market, clearly defining your ideal customer, your user personas, and having a realistic view of the competition, who they are, and what makes you different. What's your unique edge?
So demonstrating that detailed knowledge of who you're selling to and where you fit in the landscape. Finally, managing the cash. How do investors look at financial health, the startup's runway?
That's where burn rate comes in.
Yeah.
How fast are you spending your cash? Investors want to see a prudent, well-managed burn rate. It shows responsibility with their potential investment. And critically, that the funding you're asking for provides enough runway. Typically, they like to see 18 to 24 months to hit key milestones and show significant progress before you have to immediately go out and raise more money.
Yeah. All incredibly important things for founders to have nailed down. Now, let's be real. Getting seed funding is tough. What are some common hurdles startups run into?
Well, one significant challenge mentioned in our research is that getting pre-seed funding seems to be getting harder, the criteria more stringent. That very, very first bit of validation capital for just an idea is becoming tougher to secure, which really just emphasizes how important having a well-defined plan and narrative is, even right at the very beginning.
Wow, so the bar is getting higher, even for step zero, essentially.
Yeah.
What other roadblocks do founders often hit?
Adaptability, resilience. These are absolutely crucial. Look, most startups hit unexpected bumps. They need to be ready to pivot, to adjust course. Interestingly, some studies suggest startups that do pivot, maybe once or even twice, are actually more likely to succeed long-term. So showing investors you're flexible, resourceful, a problem solver, that's a big plus. Also, having a defensible competitive edge, something unique that's hard to copy. Proprietary tech is a great example. We saw data suggesting startups with granted patents are like 4 times more likely to get funding. That's a major differentiator.
So it's not just being first, but having something genuinely unique and protected. What about the wider economy? We mentioned that dip after 2021. How's the current climate playing out?
Yeah, that shift in the capital landscape, fewer deals, less total investment flowing compared to that peak. It means fundraising can often take longer now. It's more competitive. Founders might need to plan for multiple seed rounds to get where they need to go. This makes efficient capital management, showing consistent progress, and building those investor relationships over time even more critical. And finally, really having a crystal clear grasp of your market. Your TAM, SAM, SOM, total addressable, serviceable, available, serviceable, obtainable market, plus those well-defined user personas. It's all essential to convince investors you know exactly who you're building for and how you'll reach them.
So many factors to juggle. Okay, to make this more concrete, let's touch on a few quick examples. Companies that actually navigated this successfully. Our research had some case studies.
Yes, definitely. There's Company A, an innovative health tech startup. Their success seemed rooted in a really compelling vision. They clearly showed how their unique wearable tech addressed a significant unmet need in healthcare. Their pitch deck was apparently packed with strong data backing up the market size and the potential impact.
Powerful vision plus solid data. Sounds like a winning combo. What about Company B?
Company B, a sustainable fashion brand. They took a slightly different tack, focusing more on storytelling initially. They connected emotionally, highlighting the environmental problems of fast fashion. Then they backed it up with concise, impactful data on their unique solution and the growing consumer demand for sustainable options. Keeping the message clear, mission plus market opportunity really resonated.
Connecting on that deeper level, but still bringing the facts. And Company C.
Company C was a fintech disruptor. They really nailed showcasing their innovative approach compared to traditional banking. What stood out in their pitch, reportedly, was using real-life case studies and user testimonials. That kind of tangible proof demonstrated the practical benefits, the real-world effectiveness, which strongly communicated their growth potential in a fast-changing market.
Yeah, nothing beats real-world proof sometimes. So what are the big takeaways, the common threads from these success stories?
I think the key lesson across these examples is just the fundamental importance of a well-crafted pitch deck telling a clear, compelling story. That means articulating a strong vision, clearly defining the problem you solve, presenting a solid business model, showing a path to profit, and crucially, demonstrating some early traction, however small, and highlighting what makes you truly unique, your competitive advantages. Those are essential elements that really boost your appeal.
Right. So to wrap things up, seed funding is that vital first step, that initial capital injection that can make your startup dream a reality. But as we've explored, it demands really careful planning, a story that grabs people, and a deep understanding of what investors need to see. A big opportunity, a viable plan, and a great team.
Exactly. And it's so important for you, the listener, to remember there are multiple paths to get this initial fuel. From bootstrapping with your own money to finding angel investors to approaching dedicated seed funds, each path has its own pros, cons, and trade-offs. You need to weigh carefully for your specific situation.
So, as you envision your own e-business, think carefully. Consider not just the what your brilliant idea, but the how. How will you get that initial fuel, that seed capital? And how will you demonstrate its potential to blossom into something truly special, a thriving business?
Thank you for joining us for this deep dive into the world of seed funding. We really hope this discussion has given you some valuable insights and practical guidance as you embark on your own exciting startup journey. Thanks for joining us today on the eBusiness Playbook.
For the complete PDF with all the insights from this episode, head over to academyglobal.com. There, you'll find the PDF, plus other valuable podcasts and resources to fuel your business growth and career success. Thanks for listening, and see you next time.